Hey everyone, welcome back to Corporate Decoder today. ALMU just filed their quarterly report, and I'm seeing a few things that really stand out about their financial health and future plans. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is pouring money into research and development, which could be a huge win. But they are also burning through cash faster than before, and that always makes me watch closely. This is Aeluma Inc's report for the first 3 months of 2026. Think of it as a quick checkup on how the company is doing financially. The company, Aeluma Incorporated, along with its subsidiary, is showing us its financial picture. Let's start by looking at their balance sheet, which is like a snapshot of what the company owns and owes. On the 31st of March 2026, Aeluma had over $42 million in total assets. That is a big jump from nearly $20 million in June of 2025. A big part of that increase is their cash. They had almost $38 million in cash and easy to access funds by March 2026, which is way up from just over $3.6 million at the end of June 2025. This is likely due to their recent public offerings where they sold shares to raise money. Now here is where we see the impact of selling more stock. Their additional paid in capital more than doubled, jumping from about $34.5 million to over $61 million. This is the money they received from selling stock above its face value. It shows they've been raising significant capital this way. On the flip side, their accumulated deficit, where they tally up all their past losses, grew to a little over $21 million from about $16.6 million. This means they are still losing money overall, even though they've brought in more cash. Moving on to how much money they made or lost. Their statements of operations for the first 9 months of 2026 show revenue of almost $4 million, an increase from about $3.3 million in the same period of 2025. That is a modest growth of about 16%. But look at their cost of revenue, the direct cost to produce what they sell. This jumped from $1.1 million to over $2.4 million. That is more than doubling, and it is a lot faster than their revenue grew. Then there is research and development, or R&D. This is where they are investing heavily in new ideas. R&D expenses shot up from $1.1 million to over $2.3 million in the first 9 months of 2026. This shows a big commitment to innovation, but it also means they are spending a lot to create their future products. Their general and administrative costs, which cover things like salaries for management and support staff, also more than doubled, going from about $2.3 million to over $4.8 million. This increased spending is likely tied to their growth and bringing in more people. All this increased spending leads to their loss from operations. For the first 9 months of 2026, their operating loss was nearly $5.8 million, a huge jump from a loss of just over $1 million in the same period of 2025. This means their core business operations are losing money at a much faster rate. And when you put it all together with other income or expenses, their net loss for the first 9 months of 2026 was over $5.1 million. That is significantly worse than the net loss of about $2.1 million in the first 9 months of 2025. So while they are bringing in more money, their expenses are growing even faster. Looking at their stockholders' equity, we see more clearly how that capital came in. In the 9 months ending the 31st of March 2026, they had an issuance of common stock, net of offering costs of over $23 million. This is directly from their public stock sales. They also have a significant amount of stock-based compensation, over $3.2 million for the 9 months ending March 2026. This means they are paying employees and others with stock or stock options, which is common in tech companies but also adds to their expenses. Now, let's talk about cash flow. This shows the actual movement of money. For the 9 months ending the 31st of March 2026, their net cash used in operating activities was nearly $1.7 million. This means their day-to-day business operations are using up cash. In the same period of 2025, they used about $1.1 million. So, they are using cash faster from their core operations. However, look at financing activities. This is where they get money from selling stock or taking on debt. For the 9 months ending March 2026, they brought in over $24 million from financing activities. This huge inflow is mainly from their public stock offerings, which is what is keeping them afloat and allowing them to invest in growth. This is a significant change from the $15.7 million in the same period of 2025. In investing activities, they spent about $440,000 on equipment in the first 9 months of 2026, up from about $85,000 in 2025. This shows they are investing in their facilities. The company explains here that they focus on optoelectronic and electronic devices, especially for sensing, communication, and computing. They've developed a special way to make semiconductor materials that can be used in mass market electronics, like for cameras in phones, but also for cars, artificial intelligence, and even quantum computing. They also talk about how they recognize revenue, which is mainly from commercial product contracts and government contracts. It sounds like government contracts are a big part of their business. This section explains how they account for paying employees with stock. They use fancy models like Black-Scholes to figure out how much this stock payment is worth, and they recognize it as an expense over time. Here is the income or loss per S-hair. For the first 9 months of 2026, they had a loss of about 30 cents per S-hair. This is worse than the loss of 18 cents per S-hair in the same period of 2025. This metric is important because it tells you how much profit or loss is tied to each individual share of stock. This part highlights a potential risk. A large chunk of their revenue comes from just a few customers. For the 9 months ended the 31st of March 2026, 2 customers accounted for about 68% of their revenue, and as of the 31st of March 2026, almost 76% of their accounts receivable was owed by 2 customers. All these customers are government agencies. This means if even one of these big customers decides to stop buying, it could really hurt Aeluma. They mentioned convertible notes they issued for about $3.1 million. These notes can be turned into stock under certain conditions. In March 2025, some of these notes were converted into almost 900,000 shares of common stock. This basically means some debt was turned into ownership. This details their stock. They are authorized to issue 50 million shares of common stock and 10 million shares of preferred stock. Currently, no preferred stock is outstanding. This talks about their stock sales. In March 2025, they raised about $13.8 million, and in September 2025, they raised over $25 million. These were public offerings, meaning they sold shares to many investors. They also have an at-the-market offering program where they can sell up to $50 million worth of stock as needed. This section goes deeper into their stock compensation. They awarded restricted stock units, or RSUs, and stock options. For example, in the first 3 months of 2026, they granted options to buy up to 262,800 shares of common stock. The key here is understanding that this is a form of compensation that adds to their expenses and can dilute existing shareholders' ownership over time. They show that for their restricted stock units, they had balances of over 156,000 shares at the start of 2026 and ended with over 274,000 shares. This means they issued a lot of these units, which will become actual shares of stock as employees meet certain conditions. The weighted average grant date fair value per S-hair for these RCs was around $16.87. This gives you an idea of how much value is being given to employees through these awards. Then there are stock options, which give the holder the right to buy stock at a set price. They granted options for hundreds of thousands of shares, with exercise prices ranging from about $12 to over $21. The weighted average fair value of these stock options, calculated using complex models, was about $14.26 for the 9 months ending the 31st of March 2026. This number represents the estimated value of these options. By the end of March 2026, they had over 1.8 million stock options outstanding, with an average exercise price of about $8.59. This means if the stock price goes above that, these options could become profitable for the holders. This section covers their operating leases, which are essentially rental agreements for their facilities. They have a lease for an office in Galeta, California, extending through March 2031, for about $1,200 in total payments. Their total lease liability from these leases is about $1.1 million, with a current portion also noted. This shows their commitment to these office spaces. Now, let's look at what management has to say about their business. This section is like the company's own analysis of its performance and outlook. They include a special note about forward-looking statements. This is a legal disclaimer that essentially says the future is uncertain, and actual results might differ from what they predict. They are basically saying, don't sue us if things don't go as planned. They describe themselves as a company that makes semiconductors for sensing, communication, and computing. They believe their technology is unique because it uses cheaper, mass-market materials to create high-performance chips. They see potential in many industries from mobile phones to AI and even quantum computing. They highlight recent government contracts with NASA and the Department of Defense, showing that government work remains a significant part of their business. They reiterate their successful public stock offerings in 2025, which brought in a lot of money to fund their operations and business development. Their plan of operations focuses on developing their technology further and scaling up production. They want to move from just R&D and small orders to high volume production for mass markets, working with manufacturing partners to achieve this. They acknowledge they have a limited operating history and are still in the development stage. Most of their work so far has been on designing and prototyping, not yet on big commercial sales. They still need significant resources for development and market readiness. This breaks down their expenses. Cost of revenue is directly tied to the products they sell. R&D expenses are for developing new tech, and general and administrative covers their overhead. Looking at the results of operations for the first 9 months of 2026 compared to 2025, revenue did increase by $531,000, reaching almost $3.9 million. But their operating expenses jumped by a massive $5.2 million, or 114%, to nearly $9.7 million. The company says this was mainly due to increased material costs for deliveries and higher compensation and benefits, driven by new hires. This is a critical point. Their expenses are growing much faster than their revenue. Their other income in 2026 was mainly interest income, about $668,000. In contrast, in 2025, they had other expense of almost $990,000, which was from things like discounting convertible notes. So this comparison shows a positive shift in their non-operating items. This section is about their cash. As of the 31st of March 2026, they had over $37 million in cash, cash equivalents, and certificates of deposit. This is a big increase from about $15.7 million in June 2025. Thanks to those stock offerings, they are relying on these funds to keep operating and growing. Their net working capital, basically their short-term ability to pay bills, was a healthy $38.6 million at the end of March 2026, up from $16.6 million in June 2025. This positive working capital is good news for their immediate financial stability. However, as we saw, their net cash used in operating activities was over $1.6 million for the first 9 months of 2026. This shows that their core business is still consuming cash. But again, the net cash provided by financing activities was over $24 million, largely from selling stock. This funding is what covers their operating cash burn and allows them to invest in R&D. This highlights their dependence on external funding right now. This is marked as not applicable, meaning they don't have significant market risks like currency fluctuations or interest rate changes that they need to report on in detail here. Here, they admit their disclosure controls and procedures were not effective. As of the 31st of March 2026, they mentioned that their finance department staffing is not enough for the complexity of their financial reporting. This is a serious concern. It means they might not catch errors or problems accurately or on time. They are working to fix this by hiring more people and improving their systems. They state, they are not currently involved in any material legal proceedings. However, they do mention that from time to time they expect to be involved in legal matters that could affect their financial results. This section warns of potential risks. One notable risk they highlight is the impact of a prolonged US federal government shutdown. This could delay their filings, disrupt government contracts, and negatively affect capital markets. They also point out that government funding debates and debt ceiling issues can hurt capital markets, potentially making it harder for them to raise money or execute stock sales. Since they rely heavily on financing, this is a significant risk. They also warn that changes in laws and regulations, especially in industries their customers operate in, could impact demand for their products. They mention a specific instance where a warrant was exercised, resulting in the issuance of shares. This was done through an exemption from registration, meaning they weren't filing with the SEC for this specific small transaction. This is just a list of supporting documents filed with the report. Finally, the report is signed by their president and CEO, Jonathan Klamkin, and their CFO, Christopher Stewart. So, what's my take on all this? Aeluma is a company with a really interesting technology in a growing market. They've successfully raised a lot of capital through stock sales, which is crucial for a development stage company. Their massive spending on R&D and headcount shows a strong commitment to growth and innovation. However, the sharp increase in operating expenses outpacing revenue growth is a red flag. They are burning cash from operations at a faster rate, and their acknowledgement of ineffective controls is a significant concern for transparency and accurate reporting. The heavy reliance on a few government customers also poses a concentration risk. Right now, they are in a growth focus phase, heavily dependent on ongoing financing. and the market seems to be reacting to this with recent news showing mixed signals. The key things I am watching are whether their R&D spending translates into commercially successful products and if they can improve their financial reporting controls. The research tools I use to break down these filings are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.